Is it okay to do reverse dollar cost averaging with withdrawals for retirement? This was a question that came in from Chris that we answered in detail on episode 536 of the Retirement Answer Man podcast. And it really begged for an illustration of the impact of cash flows when it comes to your investment portfolio, which is a critical component that you have to manage in retirement. So this is a supplement to that complete answer. So let's take a look at an illustration to understand how dollar cost averaging impacts investments. Before we get going, all important disclaimer, this is helpful hints in education. Investments have various degrees of risk and you can lose money. So I strongly urge you to consult a qualified professional. Now we're going to use data from the S&P 500 that I got from Yahoo Finance. You can't invest in an index. You can invest in investments that mimic the index. So understand that. So why is this question on dollar cost averaging and investment portfolios important when you're establishing your investment strategy? Because they matter. They impact the potential feasibility of your retirement plan. So let's start off with a single cash flow investment. So here we have $1 million at the beginning of 2021, right at the beginning of the burst of the tech bubble. And in year one, the S&P 500 lost 13.5%. So your $1 million goes from $1 million to $865,000. And then in year two, that portfolio goes down another 22.25%. So now we're down to $672,000. And we can see at the end of year six, 2006, the portfolio goes from $1 million to $1,136,394. What's interesting is if we reverse the sequence of this portfolio, the returns that it experienced, and rather than go from 2001, 2, 3, 4, 5, 6, we reverse the order in which the $1 million experienced the investment returns. When you have a single cash flow investment, we end up with the same money. It doesn't matter. The math is the math. It just works out. But what happens if we introduce an inflow or an outflow to the same starting $1 million and same return sequences? And where we're going to do that is first look at contributions to an investment portfolio. This is probably something you're really familiar with. That's what dollar cost averaging is. You receive a paycheck, you defer 10% to your 401k, and that money goes into an investment, and then you keep repeating that in whatever sequence you have a paycheck over and over and over again. That is dollar cost averaging, and it can actually work in your favor in the accumulation phase. Let's look at that example. Let's introduce that cash flow. So here we have the same $1 million, but instead we've added a contribution of $60,000 at the beginning of every year. So year one, we have $1 million, we add $60,000 to it, and then we experience the downturn of 13.5%, which leaves us with $916,900. And then in year two, we experience the negative return again. At the end of those 6 years, we have $1,605,614. Now let's reverse the sequence of those returns again to where we have the recovery at the beginning and the bad market at the end. And we can see now we have a difference between the reverse order when we add in this contribution of $60,000 a year. In this scenario, we end with $1,464,223. Well, why is that? Why did we have an underperforming portfolio when we had the good returns early? Well, this is sequence of return risk under accumulation, in that if you have the good returns early, when you have the least amount of money invested, once you get to the bad returns at the end, that's when you have the most money invested, so you feel the most financial impact. Whereas if you have the bad returns early, when you have the least amount of money invested, once you get to the good returns coming, you have more money invested, so it's more able to recover. I don't think that's grammatically correct, but you get the point. So we can see how the introduction of deposits on a systematic basis can impact the portfolio. This is the magic of dollar cost averaging in accumulation, is the systematic investing. So you actually want more volatile portfolios, and you would prefer that the negative returns happen earlier, not later. Now let's do the opposite. And this is what Chris is getting to of, well, can't I just reverse it? Dollar cost averaging has worked really well for me. And the answer is you got to be very careful about this, Chris. It doesn't mean you can't do it. And we'll get to another consideration after we look at the numbers. So here we have, again, the starting portfolio of $1 million. But instead of depositing $60,000 a year, we take out $60,000 a year at the beginning. So we have $1 million, we take out our $60,000, then we experience the negative 13.5%, which leaves us with $813,100 at the end of year one. Now, let's look at withdrawal rates, because that's a number that we always think about. We start with a 6% withdrawal rate, but at the end of 2021, we have to still get our paycheck, our $60,000 out, which is now 7.38% of the remaining value. And here, if we go through another bear market, which we did in 2022 of negative 22.25%, we end the year with $585,535. Now, if we have to take out our paycheck, our $60,000 a year, because we're retired and we need to pay for our bills, now we're at a 10% withdrawal rate. And then as we have the recovery, we can see we never quite recover as quick because our portfolio went down. We took out the same $60,000 with no adjustments, and we end with $667,173 and a 9% withdrawal rate, which is likely not sustainable. So here, if you have bad markets early in retirement and you're doing reverse dollar cost averaging, it can impair, if not implode, your retirement strategy. And again, look at the reverse sequence of returns. We can see that we have early returns actually helps us out substantially in the portfolio maintaining some semblance of feasible. Now, 7.42% as a feasible withdrawal rate, probably not, but we still have substantially more money as a result of the sequence of returns. So does this mean that reverse dollar cost averaging is not a viable strategy for you, Chris, or anybody else looking at that? Not necessarily. Now, we teach in our agile structure, there are pillars, right? What is the vision of what we need to spend over our life of retirement? Where pillar 2 is, do we have a feasible plan? Do we have enough resources to cover our anticipated spending? And you do that via a feasibility study. We like to use Monte Carlo scenarios for that, which is a topic for another day. But when you do a feasibility study, basically answering the question, do I have enough resources for my expected spending in retirement? You're going to be categorized in 3 broad categories. Number 1 is underfunded, meaning, no, given all the assumptions, you do not have enough resources to cover your anticipated spending. And that's going to present to you some options that you're going to have to negotiate to get to a feasible plan. That could be working longer, spending less, taking less investment risk so you can protect your assets, etc. You have your own issues. Bucket 2 that you might get categorized into in the feasibility study is going to be constrained, which is probably a lot of us, meaning that given all the assumptions, yeah, your plan should work unless we have bad sequences or we have a life event. You may have to make some adjustments to maintain your constrained feasibility. And that's going to present its own options. The third bucket, which is you are overfunded, which means you have way more assets than you need to cover the liability of the spending that you forecasted for your retirement, means you have a lot of options there. And one of those options when you're looking at your withdrawal strategy is systematic withdrawals, which is a form of reverse dollar cost averaging. So if you are in the category when you run the feasibility of your plan to see if you have enough assets, where you have substantially more assets than you need, systematic withdrawal may be a viable strategy for you in implementing your retirement strategy because you have such a buffer of assets that if we go through a bad sequence, you don't necessarily implode the feasibility of your plan. But it's really important to understand these numbers so you can develop a strategy that not only is feasible, that you can have confidence in so you can rock retirement.